G'day everyone, welcome to this weekend update, and we're still in a corrective mode overseas. The Australian market has been performing a lot better than it normally would, and we've taken another step closer to what I regard as one of the best buying opportunities of the decade. We've had a pretty good year, and as promised last week, I'm going to show the results of our trading recommendations on the first weekend of each month, just so that you can see how we're going and follow along with us. So we'll start with that initially. These are the year-to-date trading results, and these are audited by an external compliance firm, so they certainly are valid. And we've made a profit so far this year of $8,120. That's based on closing prices as of the 30th of August. And it's also based on a trading float of $20,000, risking $300 risk per trade. So we're using a standard risk level for every trade. In total, during the calendar year, we've taken 44 trades, and 76% of them have been winners, which is a really pleasing strike rate. That's well beyond what most people normally get. So that's been extremely pleasing. And the win to loss ratio in terms of the size, the winners are almost twice as big as the losers. So when you combine that with a very robust win rate, it's been a terrific year. And as I said on the opening slide, I really think that once we come out of this corrective phase, there's going to be some absolutely fabulous opportunities. We've had a terrific year, but I think the best is still ahead of us. So let's have a look at the weekly summary. The S&P lost 30 points on the week, and the C leg is definitely underway. Now, these sort of corrections that you get in an overall uptrend tend to play out in an ABC pattern that we'll have a look at on the chart in just a minute. And barring any sudden news regarding Syria or any sudden news regarding the Fed winding back QE3, which I don't believe is going to happen this year, a lot of people seem to be convinced that it is, and I think it's already pretty much priced into the market. But if it turns out that they don't, and I believe that will be the case, then because they just, I don't think they've got that latitude, then this correction looks like it's going to be a pretty tame affair. We're still going to see a bit more to the downside. If things got nasty in the Middle East, we could get down to 1465. But at the moment, I'm looking in the area between 1570 and 1600, I think is probably the more likely area. So let's have a look at the S&P chart. So you can see here we've been following this chart now all year. Still clearly an uptrend. The index is still well above the 150-day moving average. That moving average is still going up at a pretty good clip. So I don't really see anything that is untoward there. There's no real signs to me that we're about to get a crash. And I read something this morning that some organisation is projecting a 90% crash. I'm not quite sure what it is that they're looking at, but I certainly don't see that. So 1570 I think is the likely area, with a possibility of it only getting down to about 1600. So we'll see how that plays out over the next couple of weeks. This August-September period is typically the weakest of the year, and then we get into a really strong 6 months. So from October through to about March, early April is typically the strongest time of the year. So it's all setting up pretty well. Now, the Australian index actually gained 12 points on the week, so we seem to be pretty much ignoring the American market at the moment, which is very unusual. So a lot of our stocks are by and large trading on their merits and ignoring what's happening in the US. Resource stocks continue to outperform, and that's really been the case now for the last couple of months, and there's some really good opportunities in resource stocks, but please bear in mind they are more volatile, and you can't just buy anything, anywhere, anytime in resource stocks. It just doesn't work that way. You've got to be selective, and you've got to get your timing right as well. But there's a lot of money to be made, and it's just a terrific opportunity. It's been a good year, and I'm probably more excited about the period coming up than I have been about the success that we've had this year so far. Gold ended up gaining $10 on the week, and you remember from last week I'd identified 1425 as a pretty key level. Well, that was breached on some fears that America was going to fire things at Syria, but then when they didn't, that partial breakout has failed. Gold stock indices, however, still outperforming gold. They've done reasonably well, and to my mind, the bottom in gold stocks is definitely in. I'm pretty confident in saying that. So let's take a look at gold first of all. So this is gold on a daily basis. We'd become overbought short term. It ran up, just popped its head above that 1425 area on Wednesday, and then has just eased back a bit over the last few sessions. So that's on the daily. Let's look at it on a weekly. So you can see we've still got plenty of room to the upside on a weekly chart, and really looking at targeting up around the 1550 mark, but we could get a bit more of a retracement back first. Let's have a look at the gold stock indices. You can see, in fact, the indices actually led the price of gold lower. The gold stock indices moved down on Tuesday and Wednesday before gold actually turned over, and that's pretty much the case. So the fact that the indices haven't really changed much in the last 2 days when gold has weakened off is an indication to me that it's not going to go very far. Let's look at the juniors. It's the same pattern, but the juniors are actually outperforming the larger gold stocks. And if we have a look at the actual division between the price of gold and the GDX index, it's still just really forming a basing pattern. If I did this same chart using the junior gold miners index, it would actually be looking a lot stronger. So I think things are still playing out pretty well in gold. Now copper slipped back to $3.20, largely currency effect. There was a bit more strength in the US dollar, and that caused commodities to come back a bit. Oil remains pretty steady at $108, and that's again largely due to what's happening in the Middle East. This is the chart of copper. So just finally, from a strategy point of view, US market's still in corrective mode. You might need to be patient for a few more weeks, and then there'll be some better buying. And it is depending a little bit on what the Fed pronounces. The very best stocks on our market are still making gains. We've had a year in two halves. The first half of the year, the focus was heavily on non-resource stocks, and they did extremely well for us. And whilst they'll still continue to do reasonably well into 2014, I think the real story is going to be in resources. So terrific opportunity there. We've got a new bull market underway, and there's huge upside in that market. But really important to understand that it's again, as I said before, not just buying anything, anywhere, anytime. It really does require a pretty coherent game plan. So that's it for this week. As always, if anyone would like to chat about the market, then please feel free to contact me. There's my email address, and always happy to chat with people about what's going on in the market. So that's it for this week. Cheers.